Hey everyone, Samuel Smith here. Today I'm going to look at Realty Income Corporation, one of the world's largest, most premier triple net lease REITs that also pays out a very attractive and consistently growing dividend, and share my thoughts on if it is an attractive buy right now. And the reason that Realty Income is on my radar is because if you look in recent years, it's been pretty weak performing. As you can see in its past history, most years it delivered positive returns, including some years where it delivered some exceptional total returns, even as recent as 2021, as it bounced back from a really weak 2020 underperformance in light of COVID. But since then, it had 3 straight years of nearly, on average, about 10% annualized losses. And this year it has recovered somewhat, but it has still been a pretty weak performer in recent years, despite its incredible track records. You can see here, dividends just increasing year after year, paid out month after month. And in particular, this is intriguing because if you look at Realty Income's historical track record, as of its latest investor presentation, it has delivered a 13.7% annualized compound annual total return, which is very strong, above the overall stock market, yet it's had a much lower volatility at a 0.5 beta versus the S&P 500 since going public. So you get higher total returns with lower volatility. That's, my friend, what you call alpha. Additionally, it's been an incredibly stable performer with every year it has generated a positive total operational return. And that's really just dividend yield plus AFFO growth. And as you can see, it's delivered a 5.5% median annual AFFO per share growth since 1996. It still has a huge market ahead of it with a $14 trillion estimated total addressable market in the net lease space. And it is a dividend aristocrat, growing its dividend year after year after year since going public, and has a 4.2% compound annual dividend growth rate since going public in 1994, which also is very attractive as it beats the long-term average rate of inflation. And we can see that this is backed up by some very strong fundamentals. It has an A- credit rating, an A3 rating from Moody's and S&P. About a third of its rent comes from investment grade clients. It has over 15,500 commercial real estate properties, and it's diversified across 92 industries, 1,647 clients, and you can see it's the 6th largest global REIT, diversified into 9 countries, and billions of dollars in gross real estate value with over 30 straight years of rising dividends. And so we're going to dig more into this today using Forecaster, which is an AI-powered tool that I've found to be quite useful in analyzing a lot of stocks. And so let's look into some of the details. Well, first of all, we're going to look into some of the technicals, and that's what I like to use Forecaster for. In particular, I think it has some really good technical analysis tools that save me a lot of time to make sure I'm not buying at a really bad time. Now, I'm primarily a valuation and fundamentals driven analyst, but I also do occasionally look at technicals to help reinforce my thesis that yes, I'm truly buying this at an opportune time. But again, my primary driver is fundamentals, just to be clear. But we can see here that the projection for near-term performance from here is not only bullish, but it has strong conviction with a 75% probability that it's going to be success. It has a 5 out of 5 robustness score, which indicates high conviction that this is a good time to buy the stock. And that's just based on historical norms and different technical factors that it looks at. And we can look at an additional indicator here, the overbought, oversold indicator, and we can see that it is oversold, which means that it is likely that the market is being too bearish on Realty Income right now, and that now could be a really good time to buy the stock. If we look at the fundamentals, we can see again it has a very attractive 5.66% dividend yield. Its ex-dividend date is tomorrow as of this recording, but by the time you see this, it could already be passed. But regardless, it's got an attractive dividend. Its dividend yield's coming up. And one thing I really like is, as you can see here, on a valuation basis, there are several different models that it uses. Now, this discounted cash flow model is probably not very accurate, and the economic value added model is probably not very accurate because they diverge so significantly from where the stock price is right now. But if you look at this right here, the Peter Lynch model and the EV to sales model, those are probably a bit more accurate. With a current price of $56.74.5 as of this screen loading, it's 47% below the fair value in aggregate. But I think probably the more accurate ones to look at are these two because they take into account factors that are a little more relevant. The discounted cash flow model, I'd have to look at the assumptions used for that, but they don't seem terribly accurate. And again, this one, high risk of bankruptcy, I don't think that's a very accurate measure because, as we just saw, it has an A-rated credit rating. This is tough to read because REITs have a lot of depreciation that they can write off some of their real estate assets, which means that their GAAP metrics often look misleading relative to their actual true fundamentals. And so regardless, this gives some conviction, especially the Peter Lynch model, that there's probably some value embedded here. And I think if you look at other things like the price to NAV, you look at the dividend yield compared to its historical averages, you look at even its AFFO per share growth outlook, I think you can come to a similar conclusion that it's pretty attractively priced right now based on its history. Now, there are some other tools that we can look at as well to get a sense of what's going on with this company. So let's look at some of these AI-powered analysis that Forecaster provides. So there are some good positives here. So, for example, the strong tenant base that we already talked about, the diversification, the high investment grade exposure, the very consistent dividend growth track record, again, decades and decades. It's a Dividend Aristocrat. It continues to grow, including entering the European market, which is a place that, for example, WP Carey has entered very profitably over the years. And so Realty Income's looking for more growth avenues as it gets bigger and bigger to keep moving its bottom line higher. It also was able to raise a $900 million unsecured term loan to strengthen its balance sheet to help drive additional growth investments. And so, those are some really positive developments for the company. Now, let's look at the business explained. Now, we already talked about this. It's a triple net lease REIT. It's called the monthly dividend company because it pays out monthly dividends. And what does it mean by a triple net lease REIT? Well, it owns real estate properties, and Realty Income primarily owns retail, which includes stores and restaurants. And then also these are signed to very long-term leases, typically double-digit years, and with contractual rent bumps. And the triple net lease component means that they don't have to pay anything like operation costs, property taxes, maintenance, etc. So that really makes it a very low-risk, high margin business where they're effectively a corporate finance business where they give companies a liquidity by buying their properties and then leasing them back to them over time. And they take out a lot of the operational and other expense risk involved in the agreement, in the contract. And that enables them to pay out very stable, highly predictable dividends. And again, they raise capital, reinvest it into buying more properties, retain some of their earnings, pay out the rest of dividends, raise some debt in addition, and they earn an attractive spread and continue to diversify and grow over time. And that's what they've done very well over time. Now, let's look at future expectations here. So we can see here that their current dividend yield is about 150 basis points above where 10-year treasuries are, which is a pretty nice spread, especially when you consider that they've consistently grown their dividend at a rate that meets or beats inflation over time. And so these are not just a spread to treasuries, but it's a spread that also keeps up with inflation, making it a very attractive income investment, especially for risk-averse investors like retirees looking to live off of dividends. Now, they are acquiring a lot of properties. They have $1.4 billion deployed on domestic and European net lease assets during Q3 alone, and they also raised their full-year acquisition guidance, given that they have good growth momentum going on. Their portfolio is very healthy with over 98% occupancy, and their huge portfolio that we already talked about with strong tenants that reduces default risk. Their balance sheet is attractive, pretty strong, and of course, over the near term, their continued growth is going to be driven by their acquisition pipeline, as well as high occupancy, and they have strong dividend coverage, which enables them to continue growing the dividend while also retaining cash flow to reinvest. Now, their longer-term growth drivers are going to be, again, their ability to take advantage of their expansion into Europe and their ability to continue to diversify their portfolio into other property classes outside of their traditional retail, which is something they're looking at. Now, there are some risks to keep in mind. One of the biggest risks for them is their interest rate sensitivity, because not only Do they take out debt that they have to refinance over time? So when interest rates rise, it reduces the profit spread that they earn on reinvesting raised capital, but it also tends to increase their cost of equity because Realty Income, given its spread to treasuries, its consistency of dividends, its track record, it's viewed as a bond proxy by many investors. And so they weigh Realty Income against what they can get from investing in corporate or even government bonds and other similar fixed income products. And so when interest rates rise, especially long-term interest rates, Realty Income tends to see its dividend yield rise which means its stock price goes down because the market expects more out of it. So that is a real risk. That's largely what has been behind their weak performance in recent years that we pointed out, because that same time period is when the Fed began hiking rates, long-term interest rates began rising, and therefore their stock came down. Even though their underlying earnings were growing, even though their dividend was not only being paid but also growing, the stock price came down and overwhelmed what they were getting from the dividend because of that pretty rapid rise in interest rates. And it is also worth keeping in mind that they do, potentially could get hurt somewhat from a macroeconomic slowdown, given that they do have tenants, some of whom are not investment grade and some of whom are not even recession resistant, although that is a small minority, and they have been battle tested over time with strong performance during recessions. There's always the tenant credit risk, of course, that could be exacerbated by economic weakness or other factors, so that's something to keep in mind. But again, they're very well diversified as well as by sector. They're very e-commerce resistant in their exposure as well. And of course, there's also risk as they expand into Europe. They could be stepping outside their circle of competence in some markets and could get hit there as well. So that's also something to keep in mind. And so we can look here and look at the qualitative scorecard to get a sense of just how high quality this company is. Would it be hard to copy it? If a competitor had unlimited money, perhaps you could replicate the portfolio, but it would take a long, long time to duplicate that large of a portfolio with the kind of experience, proprietary corporate data they have, the relationships they have with tenants that enable them to get early access or even in some cases exclusive access to deals to be able to grow and to build up. So they do have some sort of a competitive advantage there that makes it hard to replicate. Again, a proven business model through past recessions. It's not an R&D business, so that's kind of irrelevant. And they have a pretty simple business model. So even if their CEO left tomorrow, I think they would still be in pretty good hands. They're so diversified now. They have so much scale that doesn't require a genius to run that business well. Of course, you don't want a fool running it, but it's not like Tesla with Elon Musk, for example. And their revenue is very stable. Practically all of it comes from long-term triple-net leases with an average lease term of over 10 years, high occupancy, so very stable. They don't really have much pricing power. It is a pretty commoditized business, but they do have a cost of capital advantage to some degree due to their A- credit rating, which is higher than what virtually all of their peers have, and therefore they can get lower cost of debt. They also have superior economies of scale, which can give them lower overhead costs as well. And so when you look at all that, they do get a very good score, 8 out of 10 on a qualitative basis. And so that gives you a quick overview of an idea of how much value there is. So I hope this video added some value to you. In my view, I think Realty Income is definitely a buy right now because of its attractive valuation, because of its attractive technicals, because of its very strong qualitative strength, its qualitative score, its high yield, its ability to keep growing at a steady pace. I think it's not going to make you rich overnight, but it's a solid compounder. It's a great keep rich, live off of passive income type investment that at the current price, I think can deliver outsized risk-adjusted total return potential moving forward. So yes, I would rate it a buy. It is one of probably in my top 10 to 15 REITs right now if I had to put it in a scorecard like that. Okay, hopefully this is valuable to you. Again, if you like this forecaster tool, you can check it out with the link there. I also have a unique coupon code through that link that can get you a nice discount as well. So I encourage you to check it out. Again, if you like this sort of content, please subscribe to my channel. Like this video as well to help it get more visibility. Thank you so much. I'll see you next time.